I'm talking about this time and time again on this channel, and I've got extremely strong conviction in this, and most people do not necessarily think about this topic enough. Most people think about investments just in US dollars. How many US dollars can I earn if I buy this property? How much is currently Bitcoin worth in US dollars? What's currently the stock price? What's currently the gold price? But those US dollar valuations mean absolutely nothing. They mean nothing because the US dollar is going down over time massively. The supply of the US dollar expands by roughly 6.8% per annum. And because of that supply expansion, we see the value of the US dollar going down over time. So really, we cannot really look at the US dollar versus other investments. Holding cash is no alternative. Different investments are alternatives to one another. So instead of looking at things in US dollars, it's better to look at asset A versus asset B and asset B versus asset C. Then we really get a better idea of what's going on. Here, just a quick recap in case you haven't seen this before. This is the US money supply, and it grew from 286 billion in 1959 to 22 trillion in 2025. So that's a 77x over the course of 66 years, equating to 6.8% annual growth. So really, we cannot use the US dollar as a measuring stick for anything. So really, the US dollar is a very bad long-term measuring stick. We rather should compare numbers that go up with the US dollar at the same time, as in we completely negate the monetary expansion over time by dividing one thing by another thing, by comparing one thing versus another thing that both increase at the same rate with monetary expansion. For example, when we look at the Bitcoin Puel multiple, we now have an idea of what miners are currently making. It's a multiple, so we are dividing different numbers. It's the revenue of the Bitcoin miners compared to their 1-year average, and this oscillates in a relatively predictable manner. When this is high, the miners are making a lot of money. When this is low, the miners tend to rather be in trouble. And this is when we should buy Bitcoin. We should buy Bitcoin during times of distress. We should sell Bitcoin during times of hype. And currently, we're interestingly enough very much in the middle of those two bands. So the market is not necessarily super hot, neither very depressed. Here's another interesting comparison. Have a look at the current price relative to the estimated average production price. When the current price is above, the miner difficulty tends to go up. New miners enter the market. When it's below, times are more tough, and it makes sense to rather be more aggressive with buying. Currently, we are above the production costs. Now, whenever we are below, there is the potential risk of a quick sell-off. We have seen the crash from $6,400 all the way to $3,200, a 50% crash in the span of just 1 to 2 months. I lived through that crash and continued dollar cost averaging in. Most people gave up on Bitcoin at the time because Bitcoin was actually going sideways for a long time, and people thought that's the floor. And that's then when the miners had to sell off, when they had to capitulate because the current price was below the estimated average production price. And so that's when miners get out of business. The same was true during the COVID crash. And so a flash crash like this is not very likely right now because miners are profitable and they don't have to necessarily suddenly dump all their inventory. Here's another way to look at the same thing: the miner revenue in orange versus the miner estimated cost in blue. Currently, the miners are in profit. And so really, there's only 3 possible scenarios. Either the market is heating up further and further, new investors jump onto crypto, and we might consider selling, or we are rather balanced, this seems to be the case right now, or we are incredibly depressed. Now, when we're very depressed, we should rather buy much more compared to the average. And it seems like right now we should just go with our general playbook. As in, if we look at the Bitcoin power law, we are neither super cheap, that's here the blue line, which by the way currently equates to $48,000, but we are also not very expensive, which would put us close to $500,000. Now, I'm not sure if we're going to hit the $500,000 again, because in the prior bull run we also didn't hit the upper ceiling. But at 250 or even 200K, it might make sense to take some chips off the table, especially if the overall portfolio is currently over allocated to Bitcoin. That's my personal approach to the market. I try to own different asset classes, not just Bitcoin, but also property, also precious metals, etc. And I try to rebalance according to where I currently see the market and according where I'm currently heavily invested in. If I start off my portfolio with, say, 20% crypto allocation, and then crypto suddenly doubles and triples, and then maybe 50% of the net worth is in crypto, it might make sense to rebalance again and potentially even go below 20%, because after such a run-up, it might not make sense to own as much crypto compared to when we are not that high in the price. So my idea is always to have some kind of a target allocation. Have the target allocation rather high when we are depressed in the price, and have the target allocation rather low when the price has risen a lot. And currently, we should just be spot on with our target allocation because we are pretty much at the model price, which is at 109K. We are slightly above that. Still very little deviation. There's another interesting indicator that might help us time the tops, and that's the Pi cycle top indicator. Whenever the short-term moving average crosses the longer-term moving average, we tend to be very, very close to the cycle top. This was an indicator that was developed with the data up to this cycle top. But the cycle top over here was actually projected and calculated, and it was a pretty good indication. The moving average crossed on the 13th of April, and just 2 days afterwards, we actually saw the price top in Bitcoin. We had a secondary rally that went slightly above that, but in general, this is a very good indicator to show us when momentum might be heated. Currently, we are very far away from a crossing of those two moving averages. Even though the Bitcoin price continues to go up, the net unrealized profit is actually going down. So people are taking profit along the way, as we appreciate, which also is a good sign, because we don't want to have a lot of net unrealized profit, because that's again the situation that I just described a second ago. If you have 50% of your portfolio in crypto and you started out with 20% and all of that gain is unrealized, you might consider taking some chips off the table and rebalance the portfolio. And that's what happens when the market as a whole is at 80% in net unrealized profit. That's when things turn around. But the market is rather cooling off recently. The net unrealized profit is going down while the price continues to go up. So this is a healthy sign. Still, nobody has a crystal ball, and again, it does make sense to have some kind of diversification, not just for risk management, but also to be able to buy the bottoms in case we do see the crash. Now, if your net worth isn't yet that high, if your net worth relative to your income is just a few months, then it's fine to potentially be very heavily allocated towards crypto, because even if crypto goes down by 20, 30, 40%, that's okay. You can simply just use your regular cash flow to buy up the bottom, and it will matter. But if your net worth is several years of your income, say 4, 5, 6, 7 years of your income, then if it crashes suddenly by 40%, your regular income will not be high enough relative to your net worth to have a substantial impact by buying the bottoms. So the higher the net worth is, the more important it is to also own non-correlated assets to crypto. That in case we do see a crash in crypto, we can then buy up that bottom relatively effectively. So what's the worst case scenario? We've already looked at the power law. This brings us at the bottom of 45K. We also have the average cost basis of the market. That's the realized price. That's currently at 53K. Now this historically has not necessarily been the absolute bottom. We have come below that price in prior bear markets by quite a bit. 20% over here and 20% over here as well. So this would actually bring the bottom at 45K roughly. But then besides the realized price, there's also the long-term holder realized price. And in the past, we also fell below that price level at the end of a bear market. And unfortunately, that price level is even lower. It's currently at 36K. So this will put the absolute bottom in the worst case maybe to 33, maybe even 30K US dollars. I know $33,000 per Bitcoin does not sound very realistic right now, but who thought when we were close to 70K that we could go down all the way to 16K? So there is quite a lot of volatility in Bitcoin, and it does make sense to have some diversification if your net worth is relatively high and if your allocation towards crypto is relatively high, despite having a relatively balanced, healthy bull market right now, because nobody knows where the price is going. Nobody can foresee black swan events. Since the market is that balanced and no top indicator is currently screaming that we should sell, and since even the net unrealized profit is not rising, we should just go with our regular game plan. If you currently have already enough crypto exposure, then simply just keep that running. If you don't, and if long term you actually want to have more exposure, then the best is always to just dollar cost average in. And do this over the long term, potentially even beyond one cycle. So let's say you bought $1,000 worth of Bitcoin for the last 6 years. You keep it running. What kind of return can you expect? Here it is. Had you done this approach with the S&P 500 or with gold, you would be at around 120, 130K. Had you done the same for Bitcoin, you would be at 355K. So yes, there's more volatility, and yes, at one point the Bitcoin allocation was even below what the S&P 500 and gold returned. But that's why we want to expand our time horizon. That's why we do this over 6 years and not just over 1 or 2 years. So expanding the time horizon always increases the probability of actually being in profit. And if you want to be fancy, if you want to get a bit more performance, instead of just buying stupidly $1,000 every month, we can adjust this a little bit. So we can have a look at, for example, the short-term holder average cost basis. And maybe we just buy in more whenever we are below, and whenever we are above, we maybe buy in less. So whenever the current price is below the short-term holder realized price and it's the first of the month, maybe we put in $1,500. And when we are above, maybe we only put in $500. So we buy a bit more whenever we are below the short-term cost basis. We buy a bit less whenever we are above, hoping that our average entry price is slightly better than by just buying the same amount on every first of every month. Now then, over time, the question arises, if you actually buy into Bitcoin regularly, a bit every month, and Bitcoin tends to outperform traditional asset classes, over time we will have more and more allocation towards crypto, and we have to rebalance. We have to sell some of the crypto. The question is, what should we actually diversify into? I do not think that stocks is the right answer, because have a look at this. This is the S&P 500 relative to the money supply. The chart starts in 1959. This here was the dot-com bubble, then came the crash, then came a slight recovery, then the global financial crisis. And over here, this is when Bitcoin was born. Now we are very, very close to those historical heights again, right? So the S&P 500 is extremely expensive relative to the money supply. The S&P 500 is also very expensive relative to the earnings. This is the Shiller PE ratio. This chart is even longer in length. It starts in 1871. So that's now 150 years of data. And again, it goes to show how important it is to look at ratios, to not just measure things in US dollars, because the US dollar is going down over time. It's better to make adjustments as if we had a constant monetary base, or at least to compare investment classes directly with one another, where the monetary expansion impacts both of those investment classes at the same rate. And so really, I'm not a fan of diversifying away from crypto into the stock market if the all-time high relative to the monetary base is only another 8 or 9% from the current price. I think a better diversifier is gold. This is gold relative to the monetary base. This chart starts in 1959. The vertical line here, this is the Nixon shock. So this is when the US dollar was not anymore formally coupled to the gold price. So before that, international banks could withdraw their US dollars for physical gold in the US. That stopped in 1971 with the Nixon shock. So that is when the dollar became a real fiat currency. And yes, the chart doesn't look that great either. There are some resistances every now and then, and we are getting closer and closer to one of them. But still, overall, I prefer this potential upside of more than 200% versus the upside for the stock market, given this relative valuation to the money supply or this valuation relative to the earnings. And so this is gold relative to the S&P 500. Here's even more upside. So that's potentially even a 10x from here. This again is a very long-term chart. It starts in 1891. So this common narrative that stocks clearly long-term outperform gold, I think is wrong. There have been many, many decades where gold and the S&P 500 performed the exact same. This year is 100 years of data. And so I think it's much better to say that there are some generations in history that prefer gold over stocks and other generations that prefer stocks over gold. Sometimes people are getting risk on, sometimes they're getting risk off. And currently, most people are still very much risk on. Most people have way more stocks than gold. But I think actually gold is the better diversifier, especially if the allocation towards crypto is high. Gold is a risk off asset. It tends to go up when Bitcoin crashes. And gold historically is also very, very cheap. Not in US dollars, but relative to stocks, it's definitely extremely cheap. And so please, this is the message of this video. Forget about US dollar valuations altogether. Forget about the gold price being at XYZ dollars. Forget about Bitcoin hitting 100K and above. It's all just about opportunity costs. Should we get into Bitcoin? Should we get into gold? Should we get into property and into stocks? And we could simply just have a fixed ratio of all of those asset classes. But I think it's better simply to adjust the ratios, to have some kind of target allocation. If we think that a particular asset class historically is very cheap, we should be over allocated. If we think that a particular asset class is very expensive, we should be under allocated. Currently, Bitcoin seems to be quite balanced. Gold seems to be pretty cheap. Stocks seem to be pretty expensive. At least that's how I interpret the data. In other words, we should have an average allocation to Bitcoin, where we are okay if it drops by 60, 70, maybe in the worst case by 80%. So maybe not more than 20% or 25% of overall net worth into crypto if your net worth is several years of your income. And so there's then the question regarding the remainder, right? How much of this should be in property? How much of this should be in stocks versus gold? I think it is okay to own more gold than stocks right now. I am not convinced that gold very long term really underperforms stocks that much. I don't have the answer why that is. There's all kinds of interpretations. Maybe the market is simply at an equilibrium and it tends to just expand with the monetary base. Maybe productive capital isn't that productive after all, and there's an overall concentration in a few assets over time. Whatever the explanation is, I simply see the data. I see almost 100 years of sideways movement. And really what matters more here is the magnitude of those rallies and crashes. Here, from the top to bottom, what do you think? How much is this going down? The answer is 96%. So had you decided to buy gold when gold was that expensive at the beginning of the 1980s, you would have underperformed stocks massively. You would have pretty much lost the game of opportunity costs. But then on the other hand, if you bought gold when it was compared to stocks relatively cheap, then there is a more than 15x outperformance. And that's simply how I see the data. This is the long-term average, by the way. The historical average of gold relative to the S&P 500. The equilibrium gives us an additional outperformance of gold over stocks of 187% roughly. So really, I think it's totally okay to own more gold than stocks. It's a very contrarian view. Most people will not agree, but most people are also not outperforming the market. So I'm okay to have a different view than most. Besides all the medium and short-term price movements, it's also always interesting to see what happens long term. What kind of assets can we actually hold over the years? Because once we know that, we know what to do during times of potential sell-off. I think, for example, that there's no question that Bitcoin long term will appreciate in US dollars. Have a look at the percent of Bitcoin supply that has not moved in the last 5 years. This fraction tends to increase long-term over time. So there's less and less Bitcoin that's available for active trading. At the same time, we see more and more Bitcoin getting purchased by the treasury companies. And we've got the ETFs on top of that. So one might argue that roughly 30% of Bitcoin supply is in the diamond hands, or it's completely lost. At least net, this chart is unlikely going to go down significantly. We've got more than 5% in the hands of the treasury companies, and we've got roughly 7% of the supply held by the ETFs. So that means more than 40% of Bitcoin supply is in the hands of entities that tend to just stack away their Bitcoin over time. All of those curves tend to go up over time. They tend to not go down. And again, this reduces supply. This increases the value. Yes, there is Bitcoin mining of 0.83% per annum, but that mining is much slower compared to the rate of lost Bitcoin or of accumulated Bitcoin through the treasury companies or through the ETFs. And so this is where crypto and especially Bitcoin differentiates itself from other asset classes. For many other asset classes, we see as prices go up that it's mainly the short-term investor that wants to make a quick buck. But we can see with the Bitcoin rally from recently 16K to above 100K that it's the long-term holders that tend to just accumulate over time that are causing the rally. So that's what we want, right? We want that the people that buy an asset, they're not selling it anymore in the future, at least in aggregate. And this is, I believe, what we see with Bitcoin. And so I don't think it's a real question whether or not Bitcoin will appreciate in the future, especially versus the US dollar, because the US dollar has an expanding supply. It tends to grow by roughly 6.8% per annum. So this is USM2. This is official numbers by the Federal Reserve. If we look at the money supply in 1959 and compare this with the money supply today, within 60 years, the monetary base expanded by 77x, which is an annual growth of 6.8%, which, by the way, is the majority of the return of the stock market as well. Most of the stock market return is just monetary debasement. And so when Bitcoin becomes more and more rare over time because of those entities, and the fiat base grows more and more, then the most straightforward approach would be to simply use the same kind of investment tactics that we have for other asset classes, right? For the stock market, for example, we've got our savings plans, our 401ks, or for property, we've got our mortgage payments, where again, we pay in regularly with our cash flow. We can do the same for Bitcoin. For Bitcoin, it's typically called dollar cost averaging. So for example, if we buy $1,000 worth of BTC, and we do this for the long term, as we do with property and as we do with the stock market as well. If we just expand our time horizon to say 6 years, so beyond a cycle typically for Bitcoin, then it's extremely likely that over time we are outperforming classical investment approaches, because again, Bitcoin becomes more rare over time and it still gets more and more adoption. Had you followed this $1,000 per month approach with the S&P 500 or with gold, and you did this for 6 years, you'd be at somewhere around 120, 130K now. Had you done the same for Bitcoin, you'd now be at 360K. So roughly 3x the amount. And so this is where Bitcoin differentiates itself massively from the altcoin market. With the altcoins, we do not know what will be around still in 6 years, what will still be relevant in 6 years. The altcoins are highly inflationary, as in projects issue new tokens over time so that venture capitalists can sell their tokens, so that the team can sell their tokens. There are vesting unlocks. And when we look at the entire market, the entire altcoin market that's tracked here on Tokenomics AI, we've got unlocks of roughly 1 billion per week. So as long as we don't see 1 billion of purchases every single week in the altcoins, the prices of the altcoins are going down. Now, how much is 1 billion per week? Let's compare this with Bitcoin. Bitcoin has a market cap of 2.27 trillion and it's got an inflation rate of 0.83%, which, by the way, is debatable because, again, we've got the purchases by all of those other entities and we've got the Bitcoin that gets lost. But let's ignore all of this. Let's just say this doesn't exist. Let's say we really have a net issuance of those 0.83% on the 2.27 trillion. If we run the numbers, we've got selling pressure of 371 million per week. So roughly a third of what the altcoins have as selling pressure. Now, how likely is it that the altcoins in aggregate get purchased at 3 times the rate of Bitcoin when Bitcoin already has this direct link to Wall Street? I think the likelihood is rather low. On top of that, the Bitcoin market cap is roughly 7 times the market cap of the altcoins. So the selling pressure is only 1/3. The market cap is 7 times as large. So really, relatively speaking, the altcoins have an inflation rate that's 20 times larger. And that's what's causing this situation. This is the smaller altcoins, the performance in the last year. Bitcoin has roughly doubled in the last year. And just have a look at how many altcoins that are shown here have doubled. There's 1, 2, 3 altcoins that did roughly the same as Bitcoin. There's only one outperformer. The rest all massively underperformed. And this is not a coincidence. This is simply just capital concentration towards the long-term winner in the market. You can't buy Quick or Myro or Pika or Atlas for $1,000 every month and just use this as another savings vehicle. Dollar cost averaging into those assets doesn't make sense, but dollar cost averaging into Bitcoin or Ethereum very much makes sense. And so I'm taking advantage of this capital concentration process. I'm betting on most altcoins doing worse than Bitcoin over time. And that's how I create additional alpha over just buying and holding Bitcoin. I don't just dollar cost average into Bitcoin, I dollar cost average into my trading portfolio, and I buy Bitcoin and Ethereum and Solana, and I sell or short sell all the bad altcoins over time. So this is my active trading portfolio measured in BTC. And of course, there is a lot of dollar cost averaging happening here as well. There's additional capital that enters this portfolio every month. But had I not dollar cost averaged at all, then because of my relative valuation trades, I still doubled the money. So without the relative valuation trades, my portfolio would now be only at around 2.5 Bitcoin instead of 5 Bitcoin. That's the kind of impact that's doable after 4 years of following such a strategy. So basically take this DCA approach and just 2x that capital. That's then 720k versus just having around 100k doing a traditional S&P 500 savings plan. Have a look at Arbitrum, for example. This is the number of ARB tokens over time that are circulating. When the supply expands and the demand doesn't expand at the same rate, then the price underperforms. Now this is Arbitrum in US dollars, and this already doesn't look that great, right? We have seen Arbitrum going down by 60%. But compare Arbitrum relative to Bitcoin, it's much, much worse. Again, because Bitcoin has all of those inflows from traditional finance, and because a lot of Bitcoin gets lost over time, and because Bitcoin does not have this ultra aggressive supply schedule. The number of Arbitrum tokens is expanding faster even than the number of US dollars. And that's why it's losing even against the US dollar, but it's definitely losing against Bitcoin. And so my approach to generate alpha out of this is to just flip this chart around. So instead of looking at ARB relative to Bitcoin, here's Bitcoin relative to ARB. So you're going short Arbitrum, we're betting on falling prices of Arbitrum, we're betting on rising prices of Bitcoin. And what we see in orange, this is just the Bitcoin price during the same time. So we outperform buying and holding Bitcoin massively with that strategy. For example, over here, since the beginning of 2024 to today, Bitcoin has appreciated by 164%, but Bitcoin relative to Arbitrum has appreciated by 678%. Now, this is way higher than the alpha that I personally achieve, but of course, I'm also rather risk averse. I don't bet the entire portfolio on a single token, and not everything that inflates as aggressively tends to also lose that constantly. But again, it's all about the long term. It's about building wealth over several years, not just speculating on what's happening next week. Now, granted, betting on relative valuations, so something going up while the other thing is going down at the same time, is a bit more complex compared to just buying an altcoin straight out. But that's why I made dedicated videos on the topic. There's actually only 2 videos that you have to watch. So there is this one over here, using perpetual futures to bet on relative valuations. And there's this one over here, risk management with relative valuation bets. It's 1 hour in total worth of content, and after you've watched that, you know how to set up positions like this. Now, there are bets that are a bit more risky than others. Arbitrum is rather risky. Just have a look at this drawdown here. But there are also more constant winners. For example, have a look at this. This is Bitcoin relative to Balancer. Balancer, again, being a very inflationary token. Here's my offer. You watch those 2 videos, you learn how to set up those relative valuation trades and how to do the risk management properly. And then afterwards, after you've joined the community, I will send you my favorite trade. So I've got several of those relative valuation trades open, but I will send you my favorite one. And if you don't make money with that favorite trade after 1 month of holding that relative valuation trade, then I will just refund you the membership fee. So this video over here and this video over here. And if you don't make money with that favorite trade, you will get the $125 back. That's the fee per month. I of course share every single trade that I make. I don't just share my favorite trade, I share all the trades that I make in real time to the premium members. A link to premium should pop up directly here on the screen. Just click on that, it will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers!